is a different but very clever way to manage your trade. So this past week, we had very few losers, and they were very small. Several markets offered us many great opportunities. However, I chose to show you a trade in the ES again, even though it wasn't the most profitable. But I chose it because it was the only trade I took where I used and documented the second DFTS variation that I showed you last time. I think this technique can help you to learn to manage your trades in a better way and expand your horizons with the DFTS application. In the past few top trades of the week, I have shown you different ways to manage your trades while using a trade unit of 3 contracts. In one trade, I showed you how I exited 2 contracts with the first target of 4 to 6 ticks in the ES and 10 to 15 ticks in crude. We do that to guarantee profits and reduce risk quickly while keeping a runner running. In another trade, I did exactly the opposite. I exited only 1 contract at the first target and kept 2 runners. This approach obviously involves more risk. Should we be stopped while using this strategy, even though we take profits in 1 contract, it is likely that the trade still ends up as a loser. The second approach should only be used when you have a clear idea of the market direction in the medium term. Other indicators and momentum studies should be employed before taking this approach. In my previous example, you may remember that I based my decision on one of Aldo's market updates and forecasts. Today, I want to show you a third approach, one that is a lot more professional and desirable. However, you can only use it once you have accumulated sufficient experience with the DFTS. Beginners do better exiting 2 contracts at the first target because this approach has higher probabilities of ending up in profits or at least break even if the trade is stopped out after the first target. Having more winners than losers, even if the winners are small, sometimes can really help us with our confidence. So this strategy I'm going to show you today is part of our second DFTS module. So use it only after you have gained enough confidence in the DFTS strategy and its variations. Although this variation is more professional, it is rather simple and you can use it in combination with the DFTS basic recipe. Everything is exactly the same as in the basic recipe. The 5 steps are exactly the same as well. The only difference is the type of charts we use. Today, I'm going to use volume charts instead of time charts, but the ratio of 5 will be kept the same. For those of you who are not familiar with volume charts, they refer to the number of contracts that are being traded. So a new bar on a volume chart will be drawn once the number of contracts you previously chose have been traded. For example, for the second variation of the DFTS, I chose to use a 25,000 volume. That means that a new bar will be drawn once that 25,000 contracts are traded. Are contract charts or volume charts more advantageous when using the DFTS? In our opinion, yes, and here is why. Imagine that the market is moving very fast and there is a lot of volume. The 5-minute chart will need at least 5 minutes to complete the next bar. That may result in top signals being delayed and sometimes not appearing at all. However, the volume chart will form the signals much faster under the same circumstances. Obviously, if you want to use volume charts at night or during corrective periods, then the bars will take much longer to complete. Sometimes you don't get signals in the time chart, but you do get them in the volume chart, and vice versa. And sometimes you get to use better stops using the volume chart and even a better entry level. But I would not choose one over the other. A good solution could be to have both time charts and volume charts available in front of you. In the case of the ES, I like using 25,000 contracts for the reference chart and 5,000 contracts for the trigger chart. This was the 25,000 chart when I was ready to trade. You can see that the ideal setup had happened earlier. I marked it with a blue rectangle, but we have to work with what we have when we come to the market. The moving average was still up and prices had been closing above the moving average. So I had to look for a buy signal on my trigger chart. In this case, my trigger chart was the 5,000 volume chart. I had the buy signal a few minutes later. The green arrow was there, the bar was green, the moving average had already turned green, and the SAR was below the bar. But just to be safe, I waited for the flag of the moving average I've been telling you about in previous lessons. The next bar gave me the flag I wanted. Unfortunately, waiting for that flag made me lose a few ticks. But at the same time, I prefer to have this flag to avoid the changes of green to red and back and forth. Many people don't like to wait, but personally, I feel safer this way and I actually recommend it. Anyway, the bar opened at 27.59.75 and I placed my order a couple of ticks below it at 27.59.25. Again, I used 3 contracts as a trade unit. My 3 contracts were filled and I immediately placed my stop at the SAR level, which was at 27.55.25, exactly 4 points below my entry. At the same time, I placed a sell order for 1 contract for my first target 6 ticks above my entry, and that was at 27.60.75. My first target was rapidly achieved, and here's where the interesting part comes. Notice that instead of trailing the stop for both of the remaining contracts with the SAR, I only moved 1 contract to the SAR at 27.55.75, and the other I moved exactly 6 ticks from my entry. Remember that my entry was at 27.59.25? So I moved the stop for the second contract 6 ticks below that, in other words at 27.57.75. That way I reduced the risk of my trade. Should prices come back down and stop me, I would lose only 1 contract. But if prices continue moving in my direction, I will be able to keep 2 runners instead of 1. The difference with the previous strategy I taught you is that this one is much more refined and protects you better. The previous one would keep the risk for the 2 remaining contracts at the same level. Prices continued moving higher, and you'll notice that this strategy allowed me to combine 2 ways to trail the stop. The first was at the level of the SAR until we get stopped out, and the other stop placed 5 or 6 ticks below the moving average. At this moment, I have both my stops above the entry level. The trade is already a guaranteed winner. One of my stops continued being trailed at the SAR level, while the other remained about 6 ticks below the moving average. The SAR moved above the bar, and one of my contracts was stopped out at 27.61.50. That gave me 13 ticks of profits on the second contract, plus the 6 ticks of profit on the first for a total of 19 ticks. So not bad for a scalp. Now I only had 1 runner left, and I chose to continue trailing the stop for this last contract at 5 or 6 ticks below the moving average until I was stopped out. Often this technique allows us to stay in the trade for longer and squeeze extra profits. But of course, many times you end up being stopped out with this larger stop. Is that a problem? No. And the reason is because runners work best with larger stops. Once that the trade is risk-free, it is worthy to give this last runner the chance and allow prices to breathe and move without stopping us out unnecessarily. Since we are just scalping or taking small swings, 6 ticks below the moving average is not really bad. You can see on this chart that the moving average is at 27.61.66, the green marker on the right, so my stop is at 27.60. The market continued moving higher, and at this point the moving average is at 27.63.70, and my stop is at 27.62, still about 6 ticks away from the moving average. The runner has already locked in about 3 more points. You can see prices are still moving higher, and the moving average is also moving higher with a very steep slope. That's a good sign for us. At this point, you can see it at 27.65.08, and my stop is at 27.63.50. Notice that the market has already traveled more than 10 points. My stop is at 27.66, and the moving average is still pointing higher at 27.67.82. After 10 points of range, I would not be expecting a meaningful pullback, but my stop had already locked in almost 7 points, so this was already a great trade. As expected, after 10 points, I saw the SAR already moving above the bars. Now, if I had trailed the stop with the SAR as in the basic recipe, I would have already been stopped out of the trade. But that is the great advantage of introducing you to this way of managing your trade. I thought I was going to be stopped out rather soon, but by then my stop was at 27.67 and the moving average is at 27.68.53. Now in this chart, we can see some superb news for my trade, and this trade of the week lesson appeared. Notice that a new buy signal just formed. That means that higher prices were likely in the cards. Now this is very important because it allows you to see the importance of the strategy where the stop for the second runner is trailed below the moving average instead of the SAR. It gives the market space to breathe without stopping you out. So far, so good. When the market is trending, we never know when will that happen. If we are equipped with the proper strategy like this DFTS variation and proper trade management, we can truly squeeze the market for all the profits that it can give us. You can see that by now my stop is at 27.71, almost 12 points of profit secured for the runner. Once again, the SAR changed position and went above the bar, and there is a red arrow. My stop is now at 27.74.50. Trailing it 6 ticks below the moving average has proven extremely useful to keep me in the trade. You can see on the screen there is already over $900 in profits. Now we have a full sell signal, a red arrow, a red bar, a red moving average, and the SAR is above the bar. We even have the flag confirmation on the moving average, which brings me to a different point. Since the moving average has already changed position to red, I cannot continue using it as a reference to trail my stop. The last stop I was able to use with the help of the moving average was 27.75.50. That is almost 17 points of profit for the runner. Once I get into this type of situation, I keep my stop in the last position I had before the moving average changed, and I stay there until I'm stopped out. But the market changed again. There was a new buy signal, and once again I was able to use the moving average to trail my stop. The moving average was now at 27.77.71, so I moved my stop to 27.76. Once again, I was having a sell signal, and I could not use the moving average as a reference to trail my stop. The last level I could use it at was 27.78.50, so I kept my stop there. I was finally stopped out at 27.78.50, 3 ticks short of a 20-point profit for the runner, following the trade management refinement I showed you today, along with the second variation of the DFTS. The trade made a total of $1,175. I hope this example helps you understand the importance of good trade management. It would have been fantastic to keep the 3 contracts in for the 20 points, sure, but we never know when that will happen. So this approach allows you to reduce risk very early in the trade and guarantee one contract to run longer without being stopped out unnecessarily by using the SAR. The SAR technique is great, don't get me wrong, but I am sure you have noticed how sometimes you get stopped out in the middle of a large trend. That's no fun. The DFTS second variation combined with this way to manage your trade allows you to stay in the trade longer and squeeze every possible tick out of a large swing. So good luck, and we'll see you next week with another trade to share.